Good afternoon, everyone. I am Nicole Thornton, your coach and trainer for the Cole Realty Group Atlanta. Welcome to Closing the Gap. Don't forget to follow me on Instagram at yourrealestatestylepro.com.
And hey guys, this is Naysha Clark, your coach and trainer for the Cole Realty Group Orlando. You can follow me at The Right Realtor ATL FL.
All right, guys, today we have our special guest, Bradley Crowe with Atlantic Home Mortgage. He's going to give us some valuable information regarding financing. Bradley, it's on you.
Welcome, guys. I appreciate the opportunity to come in and shed some insights on kind of the buying process and the financing side of that, which is a very impactful part of the transaction when trying to buy a house. So really, the point of the discussion today is really just to kind of bring light of some recent changes and maybe the way underwriting is done and kind of educate from that standpoint. So one of the biggest things, and agents have probably heard this recently, a buzz, whether it's through the media, social media, clients talking to them. We've got loan limits that are increasing as we head into the end of every year. The agencies, which would be representative of Fannie Mae, Freddie Mac, FHA, USDA, VA, they all have loan limits as to what they qualify for, and those have started to be released as we wrap up 2021 in anticipation of what they will be for 2022. We'll also kind of talk about some of the changes when it comes to student loans and how they're calculated with the underwriter. And then we're going to discuss kind of some expanded programs, some specific stuff that we offer at Atlantic Home Mortgage, and then kind of some background as to maybe hopefully some expectations on looser qualifications and then maybe why that's necessary and upcoming. The first is, again, going back to the conventional limit. So not to glaze over some important technical stuff, a conventional loan is a loan that is going to be bought or held by either Fannie Mae or Freddie Mac. And right now, what they do is they put limits based off of the average home price in particular markets, based off of affordability for what the income levels are for the communities. And it is county specific. But for 2021, they've got those limits set at $548,250. So if you go over that dollar amount, then it crests into what is called a jumbo loan. But as long as you stay under that loan limit, then you're good to go. All of the conventional rules and the underwriting requirements for that apply. The neat thing is that they've announced for the year of 2022 that they have increased that loan limit up to $625,000. So this affords borrowers that were needing a loan amount greater than $548,250 to still qualify under the conventional terms. But again, this goes into effect January 1. So some lenders are announcing that, hey, this is what we will do effective January 1. But a lot of lenders, like ourselves, have already implemented that as an ability to do a loan today, even though the loan would close before January 1st, based off of that new loan limit at the $625,000. And why this is impactful is that conventional loan, you can get by with as little as 3% down in order to buy a house. Compare that with a jumbo loan, they require at least 10%. Most of the time it's between 15 or 20. So if you've got a borrower that was looking to buy a house at, say, $600,000, and they only wanted to put 5% in, well, they wouldn't have been able to qualify based off of that, because a 5% of 600 is a $575,000 loan amount. Well, as of a month ago, before they announced the increase, that borrower would have had to do a jumbo loan, so they'd have had to come up with more money, or they'd have to lower their price point because they didn't have 10% to put down, in which case they needed to get that loan limit under the conventional thresholds. So increasing it to $625,000 opens up the ability for more borrowers to buy bigger houses. So at the end of the day, that's good for all of us. And it's a win-win, not only for us on the loan side, a win for the agents on the sales side, but it's really good for the borrower, so they don't have to put as much cash into the transaction. So it just opens up the pool of possible people to serve. And then I put a little note down there that FHA loan limits also adjust every year based on the data, again, of what the sales prices are, the income levels of the communities, but they have not announced those yet. So stay tuned. That is information that will come out later on.
So for those individuals that may not be as familiar with the conventional and the FHA, Bradley, can you spend just a couple of minutes telling us the difference between the two?
Yeah, absolutely. So, there's different underwriting standpoints, but really the biggest benefit is that FHA will allow for borrowers that either have maybe some more lower credit scores and or higher debt to income limits to qualify to buy a house. Debt to income, fancy Banglish language for, hey, let's add up all of the debts that you have to pay on a monthly basis, your car loan, your credit cards, your student loans, and then the new mortgage payment. And let's divide that by the level of income that you receive on a monthly basis. And so with FHA, they're a little bit more lenient to where you can have a higher number than on the conventional side. The biggest thing that I encourage clients to think about is an FHA is a great product. Unfortunately, sometimes FHA gets a bad rap in the marketplace as they think that it's for less qualified borrowers and it's not as good. But I'd say that's kind of a misnomer. I'm a big fan of FHA loans. However, one of the things that I make sure to tell all of my borrowers when they're buying a house with an FHA loan is, hey guys, don't expect this loan to be a long-term financing product for you. An FHA loan is a great tool to get into the house, to get the house that you want, but it is not and should not be your forever financing tool. And the reason that is because there's a piece of your mortgage payment that is with both a conventional and an FHA, which is called private mortgage insurance, also referred to as PMI or MI. Those terms are kind of used synonymously. On the conventional side, when you buy a house and you do not put at least 20% down, then you're obligated to pay an insurance to cover the event of a default. If you were to stop making payments on your mortgage, it helps ensure the lender that they'll cover, this policy will kick in and cover any loss because the borrower didn't pay. But once you get under 80%, that stops being applicable and you no longer have to pay that. When you look at the FHA side, unfortunately, that never falls off. And so as long as the borrower has an FHA loan, it doesn't matter if their loan is 50% of the value or 20% of the value, they will still every single month be throwing away money by paying this PMI expense that isn't necessary. So one of the things that we've had a lot of success with here recently, especially with the appreciation of people's home values, is taking borrowers that bought at an FHA loan, say a year, 2 years ago, and rolling them into and refinancing them into a conventional loan to eliminate that PMI expense.
Okay.
That's really the biggest thing.
Okay. Now, I don't know if you have this in your presentation. Isn't there I think we were talking about it amongst a couple of us the other day that there is a conventional option that does 100% with no no MI. Is that correct? Or do you all have that something comparable to that?
No. So I don't know specifically on the conventional side. Well, everything that we've known is that in order to not have, to go up to 100%, it requires FHA with a down payment assistance program. So it's a grant to cover that 3.5%. But you can get a loan on the conventional side without PMI, but what you end up doing is they factor the interest rate up. So the cost for the PMI is rolled in to your interest rate. I am not a proponent for that because on a conventional loan, eventually your PMI will fall off, right? Because eventually your home is going to appreciate in value and your loan, as every payment that you make, will decrease in a balance. And so eventually that number is going to disappear. Well, if you roll it into the interest rate, guess what? Mm-hmm. It's always a part of your loan. Right. You see what I'm saying? So that's not long-term. I wouldn't advocate for that. Maybe a certain circumstance with a one-off scenario that may be necessary, but generally speaking, I'm not a big fan of it. I don't think that's in the borrower's best interest. Another thing that some changes that came out earlier this year was how the underwriter is able to account for student loan payments. And we get this question a lot where borrowers call us and they say, hey, Bradley, I think I'm good to go, but I have a bunch of student loans, but guess what? They're a deferment status. I don't have to make any payments on it, so I don't need to worry about that. Well, unfortunately, the way an underwriter is required to review that and to assess that information is not that, hey, yes, that's great that you don't have to make a payment today, but at some point you will have to start making a payment. And when you do, have we allocated enough of your monthly income to make that payment so that we're not overextending you by giving you a mortgage that's too expensive for you to afford when that event triggers? Okay, so in the current or what is now former underwriting requirements, there's different rules for the different programs. So for FHA, we as an underwriter and on the lending side had to automatically hit the borrower for a 1% of the student loan balance. So if your balance was, say, $10,000, even though you may not have to be making a payment on that loan because it's either deferred or whatever, we still have to set aside $100 of their income to cover that payment for if and when it does become applicable. Compare that, as you can see on the conventional side, it was the same with Fannie Mae at 1%, but Freddie Mac was only 0.5%. So when we had tight situations and we were doing a conventional loan, we would just underwrite it under the Freddie rule book instead of the Fannie Mae rule book. But with the new changes and the announcements that came out earlier this year, FHA has loosened that requirement and has kind of matched the best case underwriting scenario, which was Freddie Mac at 0.5%. So in that example of before, we had a borrower with a $10,000 student loan balance and we had to allocate $100. Well, now we only have to allocate $50. So that $50 could help qualify a loan. It could allow that borrower a higher mortgage payment because now we don't have to use that in our calculation, so they can buy a bigger house. So it provides a lot of benefits. But another neat little caveat that was announced is that before, we could not use any income-based repayment plans. So that's a way, like when a borrower is maybe having trouble with making their payments because their student loans or the required payment is just too high, they can reach out to their servicer or the lender, depending upon how it's handled, and say, hey, can I get what's called an income-based repayment plan? And so you send in some documentation, you fill out some paperwork, and they determine what a new payment would be for those loans that you have outstanding. Before, we were not able to use that number, but now, as long as that number is greater than 0, we can do it. So sometimes we've been able to tell a borrower, just call them and tell them that you can only do it for $25 or $10 a month or whatever. And as long as we get the printout that shows this is what their new payment plan is, FHA has to use that. Now, conventional, it's the same way as it was before. There weren't a lot of changes when it comes to that. So the biggest benefit with this new underwriting or the way that they look at the student loans is on the FHA side.
So that's a game changer because, like you said, previously you could have had a borrower that was paying, let's just throw out a number, $800 in a student loan payment, and it might have caused their debt to income ratios to exceed the maximum, and therefore they didn't qualify. So now, based on what you're saying, the income-based payment, they could be in a position to get the home that they wanted in some cases, right?
So I had that's right. So we had a borrower situation back in July where he actually had loans that were defaulted. And so he called them. I said, look, man, we can't, as a government loan, which is what FHA is, it's sponsored by the Federal Housing Authority. And having government student loans, you can't default on another government product and still get government financing for a mortgage. So we had to bring that at a default. And he was like, yeah, but the payment that they're asking for is just something I don't think I can do this. And so I instructed him on the income-based repayment plan stuff. He reached out to the servicer. They got him a payment. Now, this is an attorney that I think his student loans were $200,000 or so is what the total debt balance was. And they got him a payment plan at like $150 or $200 a month. Which is, if we had to go the rule before, we were going to have to allocate $1,000 on a $200,000 loan. So we were only having to set aside $150 or $200, whatever that number was. And now we were within the guidelines and we were to get him closed, a week and a half later. So it, as you said, can be a game changer, but only when it's understood correctly. So you want to make sure the underwriter you're working with and the lender you're working with know all the rules, because sometimes just because the rules are applicable and eligible to be followed, unfortunately, if people aren't made aware or are not keeping up with the updates, they're going to operate off of old information, and they just kind of go by what they think they know because that's what they had done previously, and they end up maybe declining or discouraging a borrower from buying more of a house because of misinformation. As I alluded to earlier, what we're going to see is what we predict at Atlantic Home Mortgage is that given the tenure that we have in the mortgage industry, is that what you'll find is the industry goes through cycles. So what the expectation is and what we believe is going to happen is as rates continue to increase, you're going to have applications dwindling because refinances are going away. And so the only type of applications are going to be just purchases. And so now it becomes an arms race for each lender to start offering different loan programs to kind of qualify different segments of the buyer pool to attract those buyers to come and work with them, as opposed to just a standard lender that a stock lender that's out there in the market. And so in preparation for this, we decided to come out with a medical program. So we call it the MD Advantage program. And I put in here a snapshot of our what all is designated as a medical individual. So a medical resident, we've got a medical fellow, just a general MD. You've got doctor of dental surgery, doctor of ophthalmology, optometry, osteopathy, podiatric medicine, a chiropractor, a pharmacist, veterinary medicine, and dental medicine. So, if you've got a borrower that falls into one of these categories, then it's something that we need to pursue to see if there's a different type of loan product that we can offer them to maybe help with either qualifications or maybe allow them to buy a bigger house than they would otherwise have to go if they were going the traditional conventional guidelines. So Josh, we'll go to the next slide. I'll show why that's impactful. So the biggest thing is I want you to focus on slot number 3 or the bullet point number 3. One of the things that we are able to do is that, again, if you think of a physician, someone in the medical field has gone through years and years and years of schooling. So they have accumulated a significant amount of student loan debt more often than not, because most folks don't pay for that out of pocket. They're getting that financed by somebody to help them get through school. And so with that, if you go back to the previous things that we were discussing on the prior slide, which is, well, we would have to allocate 0.5% of, say, $300,000 of their student loan balance to their debt to income ratio. Well, now we can just remove that altogether. So Josh, we'll go back to the other slide. Even if they're in deferment, or we can get proof that they're in deferment for at least 12 months after we close the loan, then we can omit that. And again, for a borrower that's got a significant or pretty hefty student loan balances that are out there and or payments, that's an impactful situation. And so one of the things that we have an ability to do is go up to 100% financing as long as the loan amount is less than $750,000 and their credit score is a 720 or higher. If it's a little bit lower, we require at least a 700 credit score in order to do it, but you can buy a house up to $850,000 with only 5% down. So again, kind of going back to some of the stuff we talked about at the beginning, the difference between a conventional or a jumbo loan, this would get them outside of jumbo territory and follow some of the conventional parameters, which just make it easier to qualify. So again, it allows the borrower to borrow more with putting less down, and it gives them greater capacity to afford a higher payment because we're omitting some of those debts.
So quick question, Bradley. I know you mentioned that this is for the medical field and it had a list. What about nurses? I didn't see that. It doesn't apply to them?
It does not. So this is just for, it's specifically targeted towards
Specifically
physicians.
to that group.
And that's
Okay.
not to diminish the value or importance of nurses, but the
Sure.
program was catered towards doctors. So the next thing, and I kind of discussed this earlier, is that again, as loans start to, and by loans meaning applications, because there's just fewer volume of people either refinancing and taking loan applications. So it's only up to the purchasing standpoint to drive that application volume. Lenders are going to get creative and they're going to get looser in their requirements. And so what we're starting to see is that the minimum credit score thresholds that lenders had bumped up to, most lenders are right around 620 to 640 nowadays. Those are going to start to fall. And so what that again allows is more borrowers to be eligible to buy houses. And so at the end of the day, that is the goal, is to help get more people into homes. And so we have a program now that we're going to go down to 580, or I say soon. So it is in the pilot phase at the moment, but the expectation is that within probably another month or so, we're going to be able to go live with that. And so when you've got borrowers that are 580 or above, that we'll be able to underwrite that loan and get them into a house. Now, one of the things to keep in mind is that it will be as an FHA program because conventional's threshold is at 640. So anything below 640 conventional cannot do. So when you get between 640 and 580, then it's going to fall under that FHA underwriting platform. Now, I get asked this a lot because you can Google and that can be as dangerous or as helpful as you need it to be. But technically, the FHA doesn't have a minimum threshold, or I think it may be 500. And so some people think that's, I can get a loan for it. Well, there's two challenges with that. The first is that just because FHA doesn't have a requirement to, or an obstacle to prevent a borrower from qualifying, lenders may not necessarily play in that space. And so while FHA may allow it with their rules, there isn't a lender that will do it. But more importantly, even if you do find a lender and your credit score is sub 580, the requirement is that borrower has to put 10% down. I would argue there's not a lot of borrowers that have a 580 or lower credit score that have 10% to put into a house. So essentially that ability for them to qualify is kind of moot because there's not very many people that can even participate in that type of a loan structure. So that's really just more for value add for as you have borrowers that may ask that. Just know that, yeah, you can qualify, but it requires that you got to put 10% down. And so that may kind of align expectation with what would happen if they decided to continue to proceed with an application.
I love it. So much information. I mean, and it's valuable information that each of us can use, especially we're out here in the field trying to navigate and find the best product for our client. Well, of course, we don't need to be experts, but having just a basic understanding, of what you're sharing with us today is amazing. So thank you.
Well, good. You're welcome. And I know y'all get fielded a lot of those questions. And so by no means is the expectation that y'all are to be the expert when it comes to that. But if we can arm you with enough information to at least sound competent to the borrower that you're working with, we want to be able to try to help with that.
Kanisha has a question. She says, is the medical program outside of Georgia? And is it open to all second mortgages or just first-time home buyers?
So, yes, so it's available for every state that we're licensed in. So we're licensed in Georgia, Florida, North Carolina, South Carolina. We've recently picked up like Michigan, Indiana, we've picked up Utah, we've got Oregon, we've got Illinois, we've got Kentucky. So we've got a significant amount of territory that would be eligible for. So no, that is not just Georgia specific. Awesome. To the point on for secondary homes, I would have to get back to you on that. I don't remember the specifics around that part of the matrix. Matrix is a fancy word for, hey, here are the rules based off of what you're trying to do, what are the qualifications, and what is required in order to do that. So, Kanisha, I'll have to get back with you on that. To continue the theme of the expanded programs and or loosening some of the requirements, and Kanisha, you and I have had this conversation before, but I get agents that call me and borrowers that call me frequently asking about a renovation loan. And so they Google and they say, well, FHA has a 203K program, or Fannie Mae has a home style program. So those are synonymous there. So they're basically the same product. It's just one is governed by the rules for FHA, which is your 203K program. The other is governed by the conventional umbrella and the rules that go along with the conventional loan, which would be your home style product. And so what I typically say is that yes, it's available, and they were prevalent prior to COVID, but since that they have been kind of put on the back burner and suspended. And the reason that is for one really big reason, that is the duration of the expected project completion. So what you don't see behind the scenes is that when a lender says they will do this loan, and they do that loan for the borrower and they commit all that money, and you go to closing, you get a house sold, and boom, they get it done. There's an agreement in the contract with the builder and for the loan terms that they're signing that says that they will complete the project within 90 days. Historically, that wasn't much of a problem because most people can kind of get the work done within 90 days. But in today's time, because of the supply chain challenges of getting, wood, getting drywall, getting paint, heck, you can't even get an appliance in 3 weeks or 4 weeks. You can't even walk in and buy that stuff. You have to order it, and it takes months to get to you. There's a very real possibility that the work would not be completed within that 90-day period. And why that's impactful is the lender has two choices if it reaches that 90-day mark and the project is not complete. They either have to finish it out, and they have to hold on to that loan, which means they cannot sell it to Fannie Mae or Freddie Mac or to the FHA. It will not be insured by FHA. So they have to hold on to that, which one loan, not a problem. But you start adding up all the different loans and borrowers that are doing this, and they're having to hold all of those loans. Lenders don't have just a pot of money that is never ending. So they have X amount of money, they lend it, and then someone buys it, they take that cash and lend to the next one. Well, if Fannie or FHA won't buy that loan from them, then they're going to have to stop doing business at some point. Mm-hmm. The second option, if they decide that, that's not cool, we don't want to hold on and portfolio a loan, they basically have to tell that borrower, you've got 2 days to get this loan paid off because we have to get it off our books so that we can sell it to Fannie Mae or Freddie Mac. Well, generally speaking, when the property is not complete because you haven't reached that 90-day mark, that borrower would be left with either stroking a check to have to pay off that loan, or they're going to have to go and get it financed elsewhere. Well, a new lender steps in and goes, oh, yeah, let me do this refinance for you. We'll come in here and put a loan on it. And then they get that appraisal. And the sheetrock's not up. There's a hole in the roof. There's wiring showing because the project that they were trying to do is not complete. They're going to go, thanks, but no thanks. We're not doing this loan. And so that borrower is stuck. And so from a reputational standpoint, lenders decided that they don't want to be put in that position where they have to tell the borrower, you have to pay us back this entire loan 90 days after we just did this. It's just not worth it. So it is coming. The discussions are picking back up. But what will kind of dictate and open up the flexibility to where that is becoming more prevalent will be the normalization of those supply chains. Can we get back to being able to walk into Home Depot and buying the products that we need to get the work done right then and there.
Good stuff. So Wanda says, great information for those under the 580 score. Nikisha has another question. Has Atlantic Home Mortgage started offering the 100% financing? And we are down to 5 minutes on time, Bradley.
Sure. So what is 100% financing? Because you've got USDA that allows for that, and then you've got FHA that require the loan limit is at 96.5%, and then you can get a gift by way of a grant through also loan as a down payment assistance program to cover that remaining difference. So those programs are still out there, but we don't do the down payment assistance. So we would have to refer that out to another lender. And oftentimes I like to have that conversation with the borrower to even make sure, is that even the right program for them? Because in my experience, after having that conversation, kind of explaining the process to them and what the alternatives are, they realized that probably wasn't the right thing that they felt was in their best financial sense. So, but again, all of that's going to be individual specific, because what may work for one borrower may not necessarily work for another, and vice versa. But yes, I mean, we have 100% financing products by way of, USDA program. But that's really the only ones that we have right now.
I'm sorry. For those individuals that may not be familiar with the USDA, Bradley, can you just share, like, take a couple minutes to share a little bit more information about that?
Sure. So USDA is a government loan, very similar to FHA and VA. So it's where the government steps in and says, hey, we will insure this loan in the event of default. Fancy language for if the borrower stops paying, we'll step in and pay you back, lender. So it takes some of the risk off of that lender's hands, and so it allows them to want to do more loans. The guidelines and the parameters on a USDA loan is they allow, like with VA, 100% financing, meaning that they do not require the borrower to have to put any equity or a down payment number between what they're buying it for and what the lender will finance. The downside to a USDA loan is that there's two caveats. One is that it is income restrictive, meaning that you can't make $300,000 a year and go and buy a loan or get a loan with USDA qualifications. And it is geographically restrictive, meaning that you can't go and buy a house in downtown Atlanta and qualify under USDA. So they put geographical territories as to where that is eligible. And all of that is public knowledge. You can Google USDA property eligibility, and then it pulls up a website, and you can just it requires a full address. You can't just do a zip code, so you have to plug in an address. But then you can kind of drag the map around and see what all qualifies. But that would be a potential downside to going the USDA route. Again, 100% financing is great, but if it means that you got to live out in Cartersville, and you have to divorce your spouse because they make too much money so that you can get this loan, is that the right product for you? I don't know. That's going to be an individual preference to the specific borrower.
Okay. Well, Bradley, thank you again so much for joining us today and being our special guest on Closing the Gap with Nicole Realty Group. Just want to take a few minutes to open it up to anybody else to see if they have any questions. All right. So Kinesia says, with all of the new changes for those previously turned down due to them, does Atlantic have a follow-up on them? Just wondering, since most of my clients go with you guys, wondering if they need calls on our end or if you guys do that already.
Yes and no. So we actually, because that we've gotten into the space where this is now an opportunity, we have implemented kind of going back and looking at past applications and past prospects to where this may now be eligible. I think there was 3 guys on the team in the last 2 weeks that have kind of uncovered like 5 or 6 deals that were considered dead previously that now are opportunities to go out there and get into a house.
That's awesome. And so in that regard, are you following up, I guess, like with us to let us know, hey, we spoke with them and now they're available, are they approved for financing? Awesome.
Yep, absolutely. So what we like to do, and again, y'all can tell us how you want to operate. We're kind of agnostic when it comes to that. But ideally, before we want them to start wasting your time with having you drive all the way around town to look at houses before they actually qualify, we want to go ahead and get them up to speed. And we've got an in-house underwriting process now where we can have eyes laid on it by an underwriter and go ahead and clear and determine what is their exact income number, how much, what do we need, what additional documentation is necessary, so that by the time you go under contract, we've eliminated about 50% of the work that would need to be done, and it just speeds up the overall underwriting process once you are under contract. But if you're like, nope, I just need to get out and start showing houses, well, we can get them out there and show you a house, but we want to make sure that it's fruitful time, because that's the only one of the few resources that God doesn't make any more of. So
agreed. Well, again, Bradley, thank you so much for joining us today. I mean, your knowledge and your experience in the industry is proven. with all of the information you shared with us today. So we are extremely grateful and thankful that you joined us. Guys, I will make sure to put Bradley's contact information in the chat. All righty. Well, Bradley, again, it has truly been a pleasure. Thank you so much. Hopefully we won't bombard you with phone calls and text messages today about our additional questions, but we're excited about the partnership and we look forward to working with you even more in the future. All right, guys. Well, that is a wrap today for Closing the Gap with the Nicole Realty Group. Make sure you're subscribing to our YouTube channel. And of course, we will see you next Wednesday. Bye.